So today is Thursday, September 3rd, 2015, ECB Day, also known as the day before NFP. Already, excuse me, already here on Forex.today, there's more than a dozen trading ideas. Excuse me, I'm choking on my own blood. Isn't that cool? Aren't they pretty? Look at this. This is an Aussie CAD play. What? So, lots going on Forex.today. Go ahead and check it out. So anyways, let me introduce myself. My name is Wayne McDonell. I'm the Chief FX Market Strategist for TradersWay.com. It's an ECN that allows you to trade Forex, energies, metals, indices, and binary options. It's about 90 minutes before the open of Wall Street. This is our opportunity to get together and work on our Forex trading strategies. Tomorrow for Nonfarm payrolls, I will be at fxstreet.com. I think it's, what, about the 112th month. Right? 112th month that I've done non-farm payrolls live. And it's the most popular Forex webinar in the world. How nice is that? So I'll see you over there tomorrow at fxstreet.com. Let's get going, huh? Trading is risky, 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 risky. Your past performance is not indicative of future results. You could have been a hero yesterday, but you could be a zero today. So never risk money you cannot afford to lose. So a lot going on ECB Day. And we've had the announcement already, and no changes were made. Yeah. Cool. That's totally expected. But what the interesting part of this thing is at the bottom of the hour, which is 22 and a half minutes from now, we will get the press conference, and also the other thing that's interesting, well, obviously the press conference so that Mario will say what he wants to say, announce any changes he wants to make, and then do the Q&A, which could open up a whole can of worms. So that could be interesting for foreign exchange traders. Also, the staff projections are out today, and you know, I want to review those. And we'll find out what changes, if any, they foresee in the European economy, and therefore macroeconomic economists like you and I can adjust our strategies accordingly. Now, let me get to the FX Street. Hang on, the FX Street report that was published yesterday. Un momento, por favor. Who the heck is talking? Huh? Very interesting. I've never actually seen. All right. Where are we? All right. So we're here. This is FX Street. I published a report yesterday. Oh, look, it's got 53 likes. Thank you very much, guys. I appreciate that. Spent several hours writing this article, so I appreciate the feedback. So we go into how to model the potential headline number for non-farm payrolls, right? Everyone says, "Hey Wayne, what do you think the number's going to be?" Hey Wayne, who cares? Do it yourself, right? So this is how you do it. So I go over what is non-farm payrolls, fundamental analysis, and then how to build a model. And then, so one of the things I tell you to look at is the Challenger report. And they actually link it. No, they changed my link. Was this for today? Cool, they updated that today. Let me double check those numbers because it just came out. Yeah, 42, right? 41.2. Good. Good. So good for them, QFX Street. That was really nice. So the numbers just came out today for the Challenger report, and 41.2. Last month was 105. And okay, so the big question mark is, what is the Challenger report? The Challenger report is a statistic of mass layoffs. And I forget what the definition is. You know, I don't know, 25 people laid off all at the same time, maybe 100, whatever. So it's a mass layoff. It's not just that you lost a job, but a whole bunch of people lost, right, their job all at the same time for presumably the same reason. Okay? So that's what the number is. And then, of course, what we're looking at is the trend. And, you know, so is 41.2 thousand a lot relative to past history? Well, you can see last month was way up here, and then we're back down to the lower spectrum of the average. And okay, and so you put that into your model and say, all right, maybe all these other indicators have added jobs. So you would add, you know, weekly jobless claims and the trend in non-farm payrolls, headline numbers, and, you know, various other aspects, ISM, services, employment subcomponent, all these different things go in, and then this would be something that you would subtract from. But generally speaking, this is good. 42,000 lost their job. That's good. You're like, what? How can that be good? Well, okay, it's not good for those 42,000 people, but it's a lot better than last month where 105,000 people lost their job, right? So this is sort of on the low end of the average, which is a good thing because this is people losing jobs, and the smaller the number, the better. So again, if you want to learn how to build your model, and then, of course, how to trade when the actual headline number comes out, and what do you do with revisions and all that kind of stuff, that is here. Beep, beep, beep. And I would appreciate it, as others have, if you would give it a like. Vote up! I like that. Vote up. So anyway, so that Challenger report came out, and there it is. What does 42,000 mean? Well, now you know. So how are you guys feeling today? Yep. Well, you say the markets seem choppy. There's an open position on this account that we made yesterday. So 23 and a half hours later, and nothing's happened. So you say choppy, and I say nothing. So here we are. There's the trade. That's the entry. That's where we are. Yeah. So I guess it all depends on what strategy you're employing, right? If you're scalping or swing trading. So that one was easy. Just to go back to that, where was it? Beep beep. Which one is it? This one. Yeah. So this one is an amazing trade. It's got a 33 pip stop, 66 pip winner. Just a little 2 to 1. And it's just sitting there. Yeah, oil, waiting for something to happen, huh? Waiting and waiting and waiting. Cool. But I am happy to see it back above the 42 handle, because anything below 40, like I said when it happened, was overshooting in my humble opinion. It's really cool that I was so clear that it just didn't make sense for me for oil to be that cheap. I was okay with 42. 40 I understand, because maybe it wants to come down and tickle the psych level. But when it was at 38 and stuff, I was very clear. I'm like, guys, I don't know what it's going to do. And how often do you hear me say that when I'm just like, I don't get it. I don't really know. It could fall from here, I guess. Right? Yeah, Demeter's like, that was the first time I'm like, and it shouldn't be 38. It was supposed to be 40, 42. And what happened like 2 or 3 days after that? Boom! We're at 48. Well, there you go. All right, so some people think it's gone back down again. Okay, well, that's why we use technical analysis, right? Because fundamentally, nothing's changed. Oh, what? We've run out of oil all of a sudden? Right? Like, so what's changed? Well, look, a shorter term trader is going to play the higher lows and higher highs, right? And there's plenty of, right? As soon as this was done, bulls are going to play, right? So, like, for example, a cheeky monkey would have tried to buy this, right? Now, the problem with that is it's still lower than this previous support. So as long as price is lower than this area, okay, as long as price is below sort of that area here, because of this consolidation, this wick, then technically it's still a bear. So even though this is a reversal, how would you be that smart? Why would you buy in a downtrend? Even if you made a ton of money on this, it's still a dumb trade. Why would you be buying in a falling market? It just doesn't make sense to me. You're just a degenerate gambler. And if you're trading other people's money, then you're borderline criminal, right? Negligent. So now you go this way. Now that it's made a higher high, what do? Okay. You look for a retracement back to somewhere between the 382 and 618 Fibonacci retracement, ideally around the roll reversal area. How many times have you heard that? 100 million billion, right? Or as my kids say, like 100 million thousand. They're young. That's a lot of thousands. Okay. So at that point, the market's bullish. And that's on the hourly time frame, right? And then I'll make an adjustment in a second. But then you got to go out to this trend. And this is where the bears are going to play, right? So what is a bear going to look at? Do. Hey there, boo boo. I am a bear. And I am going to sell the WTI. All right? How about that? How does that make you feel? There you go. So somebody's going to sell that because they're a bear. Okay? If you're not doing one of those things, then you're just confused, right? If you're not a bull and if you're not a bear, what are you? You're a pig. And pigs get slaughtered. Okay? So now, So you got that angle. So someone's trading the 50. Oops. Sorry. Good. Boop, boop, boop. Okay. And there's a 50 down here. You see that? So let's move this around. There's a swing 50 low and a swing 50 high. And you need to decide what team you're on. Beep. Okay. Holy smokes. There you go, yo. Okay. All right. Cool. How about the beast? Who trades the beast? Boom, 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 boom. It's almost like a heavyweight prize fighter coming into the audience. Coming into the audience. It needs its own theme song. Here comes the drums. Okay. Cool. So this is the beast. Is the trend up or down? Down. Okay. So you sell it to 21, sell it to 21, sell it to 21. And that'd be it. That's why we use the 21. So the 21 is below the 55. So as of this point here, the market technically, it's not an opinion. Technically, the market is bearish. Okay? We're below the 21, and we're bearish and aggressive. And the 21 represents a dynamic level of resistance. Okay? So that's a sell zone, if so to speak. And this is when I say this is what you sell green candles, right? What I mean is, right? Down, 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 up. Look, it was up for 4 hours. Where did it go? To the roll reversal. Sell. Down, down. Look, it was up for 4 hours. Down, 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 down. Okay, end of day, whatever. Retrace all the way back to the 21. Sell, sell, sell. Down, 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 down. Up, up. Sell, sell, sell. Down, 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 down. Right? Up, up, sideways, 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 right? Wait for the 21. Down, 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 down. Up, up, sell. And now we're in this mode of potential down, 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 down. What's the indicator giving the coral and green, like, that's funny, green blocks wane, the coral, that's so funny. Yeah, what, obviously you're educated in colors, you're like a fashion designer. They're pivot points. Based on the previous period that you're measuring, it's predicting the highs and lows. So on a big breakout, what happens is the pivot points get messed up because the previous range was unusually large. So this range is going to be unusually large, but that's unusual, right? So on these weeks, and I'm glad you bring it up because, again, I don't know what you don't know, yo. So on these expansion weeks, what you use as pivots is the S1 and the R1. That is now the target for the week. Okay? To be more conservative. Now, this is a fast falling market, and we just might continue the sort of velocity of money into JGBs. And the other thing to sort of add is what I'm looking at here is the top of the week right now is the weekly central. So if that continues to hold, meaning if we do break below the support pivot and we do continue the aggressive move down, what's the target for the week, guys? If you were on TV talking about the pound yen, what would your target be if they ask you, whoa, so what do you think? Oh, well, we're targeting X number on pound yen. Weekly S2, correct. So you're going to say, yeah, our firm's looking at 179 on the pound yen by the end of the week. Wow, you sound so smart. And that's because the typical range when you're using pivot points is M3 to M1 if it's bearish. So that's the typical range. But we have an unusually fast moving bearish market, and the current top is here, right? So what you do is you adjust. Instead of M3 to M1, you use central to S2. And that gets you your 179 even Steven. Hallelujah! 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 Yeah. Cool beans. Nice. Anything for you, pal? Okay, so what should we look at? A lot of consolidation while we wait for the ECB in just a couple minutes, but also non-farm payrolls tomorrow, right? So this is consolidation week. Guess what? Summer ends tomorrow. Monday is Mutual Fund Monday. And game on. Do you understand that? Monday is the beginning of the rest of your life. From Monday on until Thanksgiving, I'm going to tell my friends to go away. Hey, Wayne, let's do a Vegas trip. Shut your mouth. Go away. You're a distraction. Here's a rock. Go hide under it for a while. See you next year, Bubba. I'm busy. Daddy's busy. Daddy's got to make some pips. When the pips are rocking, don't come a knocking. And I'm serious. So I'm so happy and thrilled and excited. It's like, I don't know what people must feel like when they're going on vacation, but I don't do that. So, how many days of vacation did I take this summer? You guys know. Right? Were there any days where I'm like, dude, I just can't make it. I'm going to take a week off. I'm going to go to the beach and, I don't know, collect seashells. What the hell do people do at the beach? I'd just be sitting there like, why am I not in front of my charts? How come I'm not making money? You're like, what am I doing here? Oh, this is called fun. Fun? This feels like a giant waste of time. Oh, but the sun's setting. The sun's setting? That means Asia's opening. Why am I here? Gee whiz. Hate-vation. After you do currencies for like a living, go to Vegas. Because I used to go to Vegas all the time. I used to speak there, I don't know, once or twice a year at least for Forex stuff. And, you know, I used to do the Forex show. I used to do the future show. I used to do the option show. Um, and then there was the trading one. And anyways, you walk through the casino and you're like, what do these guys get out of it? Right? Because you're like, man, it just doesn't even look exciting compared to Forex. All right, so Draghi's going to go. I'm not going to play it in the background. We'll let the market move. But I'm hoping for the stock market to go up, right? So that's the analysis we did yesterday. How did we do? Well, it looks like we did actually bottom out. I'll call this a 618, which predicts a 1382 as a top. Look, how awesome is that? Isn't that funny? So when the stock market goes up, what should the USD yen do? Up. If the stock market goes up, what should the euro dollar do? Bravo. Very good, guys. Sam, your entry on the DAX is about a year late. But, all right. Well, hang on. I want to look at that, but I'm going to get distracted. No. You're supposed to be on currencies right now. Draghi just started talking 2 minutes ago. This is why I'm asking you, like, what are you watching? What are you doing? I guess we could watch the DAX and call it a Euro play. I feel like it's just going to be noise. Okay. Okay. Oh, so, okay. How about this, Sammy? Tell me, what do you want to do, buy or sell? Oh, and by the way, Sam, and to everybody else in Europe, I don't know if it'll ever happen again in your lifetime, but when a central bank tells you they're going to do quantitative easing and they're going to do it for years and they're going to pump trillions of euro into the market, the whole point is to increase asset prices. So on that day, you buy the stock market and go away. It's free money. So like to do something like 9 or 10 or 12 months later is just, I mean, I don't know, picking up crumbs, right? You're an Aussie? Oi, oi, oi! Cool. But there's that. So tell me, are you a bull or a bear? Do you want to buy this or sell it? You want to? You said an entry. Entry what? Okay. Well, so you're like working on an entry. Let me just tell you technical analysis. How about that? So there's no opinions here. There's a couple of things you can do. One, just like I showed you on the Beast, you buy at the 21. That's why it's there. Okay. 21 is above the 55. Technically, here we're bullish. It's been up all day, making a higher high. It retraces down to the dynamic level of support with the little Stokes kicker, and you buy it. That's why it's there. You see what I mean? So, like, you know, you're working on your entry. Well, it should be easy. That's what that line is for. Okay? So again, the 21.55 represent a bullish market, and each one in of itself are dynamic levels of support. If price hits, excuse me, if price hits the 21 and starts to move up, you're bullish and aggressive. There's no resistance in this market. It's going to go up forever. Forever, forever, ever, forever, ever. Yeah, forever, ever until it stops going up. But it's one of these things like some people say, well, what if this holds? And well, what if it? And they're like in between, right? Well, what about this? And what about that? I wanted to long it, but, and they're all over the place. They're just an emotional mess. If you're above the 21 and you're moving up in an uptrend, there is no resistance. It's going to go up forever. There's no resistance anywhere. The only sort of conservative exception to that would be like a weekly R2. And in that situation, more often than not, it's best to play the law of averages. Just go ahead and take profit, and then maybe re-enter on a pullback. Okay? But other than that, it's just going to go up forever and ever. It's going to go up 2,000 pips. And then one day, or 1 minute, 1 hour or 1 minute, it'll stop doing that, and it will come down. But you'll be stopped out, and it'll be fine. But it's the mental attitude that it's going up and nothing's going to stop it. You're bullish, you're aggressive, you're long and strong. Down to get the pippin on, right? Now, if it comes down to the 55, the market's still bullish. But now what? Well, it's a lot less bullish. It made such a large retracement. Therefore, I think we're vulnerable to a double top, meaning I do believe there is resistance in the market now. See, if the 21's in control, there's no resistance. It's going to go up forever like a hot knife through butter. If the 55's in control, there is resistance, and we probably won't get past this peak, this psych level, and that's that. Capiche? Now, the other way of playing it is you look for what used to be resistance is now support. And that does show a drop to the 55 and then probably up to here, and then we range. Okay? What I mean is if you pull all the way back to that 55, then we're probably going to play this range because the drop to 55 tells you there is resistance in the market, and then you ask yourself, well, where's the resistance? And then you eyeball this, and you do that, and yada, yada, yada. All right. In fact, what I often do is I look for this actually to be resistance as well. So it's really this here, okay? That whole area. Was that helpful, ladies and germs? Just a quick basic review? Cool. So hopefully we're getting some nice staff projections. Let me give you an update. If I have one, hang on. Let me check my notes. Here it is. Just came out 10 seconds ago. And not quite, hang on. I got the numbers, but not the old numbers. Hang on. No, they're being released as we speak. And all right, good. Boom. Within 1 second, I got the updates. Okay. GDP cut. Wow. Okay, so they cut the staff, the ECB staff cut European GDP. They for this year, they cut GDP for next year. They cut GDP for 2017. Wow. Inflation. Don't have them yet. Okay, so quick update. ECB staff projections for 2015, 2016, 2017 GDP cut across the board. Year after year after year, less GDP growth. Goodbye, Euro. I just got stopped out for profit. What a shocker, guys. Oh my gosh, really? Yep, easy 66 pips. Nice. Isn't that easy? Just like that. Snap of the fingers, 66 pips. Thank you. You're welcome. Cool, man. Apparently, people don't want euro, they want US dollars. Hey, awesome. A little bit of movement in the USD CAD, lots of movement in the yen. So, what are they saying? What's the world saying, guys? Let me be frank. They're saying get the hell out of euro and move it to Japan or the United States. Now, I think what they're buying is, I don't know, JGBs, right? And they're buying U.S. stock market. Now, wasn't there a time when they would buy U.S. treasuries and Japanese treasuries? So why, what's going on? Why would they buy? Because I don't think they're buying the Nikkei. So again, I don't really know. But what do you think's going on in my brain? Why would I say investors around the world are buying JGBs, but they're buying the U.S. stock market? Bueller? 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 How about this? Type a question mark if you'd like me to tell you. Look at this. The pips are just rolling in. Love it. Love it. Aha. Great. Cool. All right. They're buying JGBs because it's a safe haven. The two most mature bond markets in the world are the United States of America and Japan. So what's the difference between these two? Why would you want JGBs but not U.S. Treasuries? Well, is Japan going to raise interest rates in the next 6 months? Yeah, probably not even in the next 6 years, right? Is the United States going to raise interest rates in the next 6 months? So if you bought a bond today, let's say you bought a 1-year treasury. It's what do they call it, a note? Is it still a note? When does it go from a bill to a note? I think that it's a note, right? A 1-year note or 2-year note. Nice, safe investment, right? What will happen to the price of that bond when the Fed raises interest rates? Now, it might be this, on the 17th. It might be the end of October. Maybe it's the beginning of December. But at some point, they're going to raise interest rates. What happens to the price of the bond? If interest rates go up, the value of the bond drops. Why? Well, think of it. Think of it this way. If you were going into the marketplace, the secondary market now, and you wanted to buy a bond, let's say you have two choices. And I'll just dumb the numbers down. You can buy one directly from the Treasury and it pays you 1% interest. Or I can buy your bond from you that you bought in the past before they raised interest rates, and it pays 0.5%. Why the hell would I buy yours? Right? It's like, what if a new car and a used car had the same price. Why would I buy the used car? This was a problem actually during the financial crisis. New homes were cheaper than used homes. Why would I buy a 20-year-old house when I can get a brand new one for cheaper? You understand? And that's because the people already owned a house. Their mortgage was worth more than the value of the house, and they couldn't possibly sell it for less than the mortgage, so their price was artificially high. But a brand new house, you could buy right from the bankrupt, but home seller or builder or bank, and you walk away with a brand new house, right? So again, now put it in perspective. Why would I buy your lame-o 0.5% bond from you, your used, dirty little bond, when I can get a brand new, newly printed bond from the U.S. Treasury that pays me more money? So what are you going to have to do to get me to buy your lame-o 0.5%? I mean, it's going to pay 0.5% until it matures. I can't change the interest rate. So you're going to have to lower your price to make it worth my while. Is that a reasonable way to describe how the bond market works, guys? An understandable way? Because some of this can get esoteric and complicated, right? Cool. So this is what's going on in the mind of a bondholder. They're like, I got to get out of euro, man. I got to get out of euro because it's losing value. Everything in euro is losing value. So they're like, I got to put it somewhere else. I'm going to move my treasury holdings, right, over to JGBs, because they're not going to, interest rates are not going to change on my JGBs. So I can lock that in for a couple of years and I'm going to be golden. And then for my riskier parts of my portfolio, I'm going to buy the U.S. equity market because I'm guaranteed to lose on the bond market. So why would I buy a losing bond, right? So I'm going to buy the equity market. Ba-ching! Right? Something to that effect. Cool. Lovely. Lovely. Look at it. Just awesome. So euro dollar way down. Pound dollar, hardly anything. Aussie dollar, hardly any move. Canadian dollar, slight move. But why did the Canadian dollar move? We had some Canadian news. Okay. So Canada's moving, but it has nothing to do with the ECB. Okay. So big moves across the board in relation to euro. The S&P 500 spiked straight up on the ECB news. Think of it. Isn't that interesting? The ECB says this year's not going to be as good, next year's not going to be as good, the year after is not going to be as good, and the S&P 500 spikes immediately. Why? It has nothing to do with the United States. And it wasn't even good news. Or was it? Well, because it wasn't good news, investors in the European market say, oh snap, I got to get my money out of Europe. So they got to put it somewhere. That's why I say, look, stock market went up. Okay, isn't that nice? Now, is this what Draghi wants? Or is this bad news? It's exactly what he wants. In fact, they're probably making the numbers up for all I care, right? Remember, I was talking about this when the euro dollar was going up during the summer. Remember how many times I talked about this? That I said, imagine you're Draghi, you've spent trillions of dollars to weaken the euro, or trillion of euro to weaken the euro, and the stupid thing's going up. And I said, well, just wait till the third week of August. It'll go down. Don't you worry about it. How many people can verify that that was absolutely, totally clear across the board? We must have talked about it 100 times in various different ways that the euro dollar is going up, and it was great because the whole point is to sell it, and it's going to fall the third week of August. Now, that was last week. Oh, but we were at 116 last week. Now we're at 111. Oh, well, I guess that counts, right? Cool. And this is just the beginning. So when we were at 116, I said, look, I don't know where it's going to go. It can go higher. It can go to 120, 125. I'm not in control of that. But if it will go down. Oh, it will go down. And forget parity. It could go to 80. Cool. And this might be the true beginning of that trip. And it's exactly what Draghi wants. Okay? So how did we get into this predicament? Do you guys mind if I go into the fundamentals? Because the market's moving. I don't know what you want me to do. Like, am I supposed to throw you into 5-minute trades? I mean, you can do it yourself, right? It's falling. Don't buy it. Okay? So you can do the pipping while I do the talking, right? All right. So we have the financial crisis, and then it finally hits Europe, and the pigs, Portugal, Ireland, Greece, Spain. Oh, and I forgot Italy, sorry. Portugal, Ireland, Italy, Greece, and Spain get into some serious trouble. What happens to bond yields? Well, there was an issue where nobody wanted to save these economies. It was in real free fall. It was really bad. Very, very, very bad. Then one day, at the height of the financial crisis in Europe, there was a turning point. Draghi said one sentence, and it changed the world. Draghi said, I'll do whatever it takes to save the euro. That's it. What does that mean? Well, it was implied, and he knew what he was saying, but it was an implied guarantee that Portugal won't default, Ireland won't default, Italy won't default, Greece won't default, Spain won't default. And if it did, the European Central Bank would guarantee they don't. Now, you're a bondholder, and you can assume some risk, but you can't assume complete risk, right? But you're sitting there going, wow, a Greek bond pays 18%? But you're like, but it's almost for sure going to default. So you're not really interested. So who's going to save Greece? Well, it would have to be the ECB. But does the ECB actually have that much money where it could save Portugal, Ireland, Italy, Greece, Spain? Like it could just bail everybody out all at once? There's not enough money in the world to do that. but you can do it by saying the words. So all of a sudden, he says, wink, wink, nudge, nudge, I'll do whatever it takes to save the euro. You know what I mean? Wink, wink, nudge, nudge, I. And suddenly he gives the green light to the rest of the world, which is the bond market, and it must be, what, 100 times bigger than the stock market? He gives the green light to the rest of the world to say, invest your money, grab these yields. They're not going to default. And suddenly money flowed in to places like Greece and Portugal and Ireland and Italy and Spain. And these countries were paying 12, 15, 18, 20% on their bonds. Why? Because nobody was investing in these countries. So it's almost like an auction where Spain says, man, we need money. And imagine there's all these investors, and it's like a reverse auction, right? They're like, all right, well, I'll pay you 10%. No bidders. I'll pay you 11% interest. No bidders. I'll pay you 12%. No bidders. I'll pay you 13%. No bidders. I'll pay you 14%. One guy says, yeah, I'll lend you at 14. All right, but it's only $1 billion. We need $100 billion. So then they say, well, how about 15? I'll give you some on 15, right? And it's an auction. But soon as the ECB says, we'll do whatever it takes, we'll guarantee these bonds, wink, wink, nudge, nudge, then the amount of risk that the bondholders are taking are exponentially lower, almost zero. So all of a sudden, boom, everyone wants that 15% interest rate, right? Because what was the United States paying? Zero. What was Japan paying? Zero. What was Greece paying? 20%. Like, holy crap. Right? To put it in perspective, right? So anyways, here's what you do. You buy the bonds, and the interest rates fall and fall and fall and fall and fall. And they actually fell all the way down to where they were actually about the same as the United States of America. The Spanish bond was like a U.S. Treasury. Went from 18% to like 1 or 2%. How much money did the ECB have to spend to bail out all those countries? Zero. Isn't that nice? Isn't that smart? But what happened when trillions of dollars and yen and peso and other currencies, what happened when all that money flowed to Europe to buy those bonds at 15 and 18 and 20%? No. Foreigners were buying European bonds. You can't use yen and dollar and peso to buy European bonds. So they convert them to euro and then buy these euro-denominated bonds from these, various sovereigns. So the euro skyrockets because the whole world is buying euro so that they can buy this debt paying unbelievably skyrocket high interest rates. What does that do to inflation in Europe? Inflation falls. No. 1 euro suddenly can buy a lot of product. Because a euro was worth a lot of dollars. A euro was worth a lot of yen. A euro was worth a lot of peso. You understand? The euro, because everyone on the planet was buying it, the value went up like crazy. So now you don't need much euro to buy anything, which means deflation. And there Europe was stagnant. No inflation whatsoever. So now the cause and effect, right, is moving on to the next level. So now that the countries have been saved and a year or two has gone by, now they have to squeeze the investors out of the European sector now that interest rates are normalized. How do you do that? You devalue the euro. So you're earning 18% on a bond, but the euro's dropped 30% in value. So now you're getting paid lots and lots of euros, but now they don't buy anything anymore. You understand? That's what quantitative easing is doing. When you need more euros to buy a can of, Coke or a loaf of bread, prices are going up. That's inflation. So if you need more euros to buy shares in a European company, like if you're looking at the DAX, and you want to buy some stock in BMW, now the prices are going up because you need more euros to buy that same share. Oh, the stock market went up. Yeah, of course. Prices have to go up because the euro doesn't buy you as much as it used to. That's why when they announce quantitative easing, you just buy the German stock market. It's free money. Just do it. It's easy. There it is. Buy it. Now you own, right? Now you own BMW, and it's going to keep going up because they're just going to print more money. It's going to create inflation. Imagine the value of the euro drops by 10%, but BMWs sell exactly the same number of BMWs, right? Let's say BMW sells the same amount of cars, but the euro loses 10% value. So prices have to go up 10%. So what does BMW report on their annual report at the end of the year? The sales went up 10%. Woohoo! What an awesome year! No, you sold the same amount of cars. And yet, then people start buying it. Wow, sales are up 10% at BMW. What a great year. No, it was just foreign exchange. That's it. The value of the euro went down. So another interesting fact, when gold was $2,000 an ounce, the South African rand was very strong. Then gold dropped by 40%, and South Africa became more profitable at the lower gold price than they were at the high gold price. How could that possibly be? How could you be, let's say, more profitable at $1,400 per ounce versus $2,000 per ounce? The reason is the value of the ZAR dropped more than gold dropped. And as you know, this commodity is priced in US dollars, not South African rand. And do the gold miners and producers, do they pay their employees in rand or do they pay them in dollar? rand. So guess what? The gold miners in South Africa were more profitable because they were being paid in dollars, which could now buy more ZAR per dollar at $1,400 per ounce than at $2,000 per ounce because the ZAR was so much more valuable. So the value of this rand falls more than the value of gold, which is also priced in dollars. So then they pay all their bills, their electricity bills, their employee bills, and all that kind of stuff in rand. And there's more rand left over because the dollar buys more rand than it used to. And they make more money at the lower prices. Isn't that awesome? Prices fell. Prices in gold crashed. And South African rand or South African gold miners had never been so profitable. Welcome to the foreign exchange market. So, hey, peace on earth. May the pips be with you. May your profits be above average. Great day. And I'll see you for non-farm payrolls tomorrow. Cool. See you guys. Once again, thanks for being on my team. I appreciate your effort and your loyalty. Cheers.